In this morning's U.S. Bank Economic 360, a look at reports on just how companies are faring in terms of reported earnings and other important trends. These reports detail just how well or how weak trends were in the second quarter, and they'll be closely watched since the first quarter was so negatively impacted by the harsh winter weather. For perspective, we turn to our very own Jim Russell, U.S. Bank's Wealth Management Senior Equity Strategist, who's with Rob in the studio. Rob and Jim.
Thank you very much. So that first quarter, as Peg just said, weather did hurt it. How bad was the first quarter? And we're going to start seeing earnings here as we speak for the second quarter. What are you expecting?
Well, just mentally rewind to the first quarter. Winter weather really shut down a number of things for weeks at a time. And the winter weather wasn't confined here to the tri-state area, Rob. It was really extended as far south as Atlanta and Dallas. What we expect to see for 2014 for the remainder of the year is moderate revenue growth, 3 to 5%, which does represent a bit of a pickup on the top line. That, frankly, revenue growth has been the elusive metric for many of the companies in the S&P 500. A maintenance of margins, as we think revenue growth grows, we think margins remain at historical and all-time highs. And we do see a little bit more strength from domestically based business. It does appear, unfortunately, Europe continues to stagnate just a little bit, a 1% growth rate. China also a little bit on the weak side, so really the metrics look good right here in the good old USA.
But the stock market has been going gangbusters.
Right.
Is that because of earnings? I mean, it's not always the case.
Right.
Stock doesn't always follow earnings.
I think a lot of people have the very same question, Rob, and that is, how can Main Street be kind of stuck in first gear and the stock market hit all-time highs on a continual basis? We've hit 14 new records on the Dow this year, and you know, here we are halfway through the year. So what we're seeing is that earnings are likely to start to accelerate as we move through the year. You mentioned the first quarter, up only 3.4% year over year. We're expecting about a 5% increase in the second quarter and low double-digit type numbers, call it 10% in the third, close to 12% in the fourth quarter as we move through the year. So the stock market likes accelerating earnings. It likes the fact that the Federal Reserve is keeping interest rates low. It likes that profitability is at an all-time high. It likes that dividends being paid is an all-time high. And it likes the fact that inflation is low. So it's really a combination of a couple of things.
Throw a little curveball at you. So the chances of any kind of a major correction this year are pretty high. That's just what happens. Do you think investors are sort of past the point of panic? Are we far enough away from 08, 09 so that if a correction does hit, they won't run for the exits?
It's a good question. The skepticism level on our high net worth clients at U.S. Bank Wealth Management remains very high. Again, kind of marking how can the markets do so well and Main Street's kind of be stuck a little bit, struggling a little bit. Aren't the markets ahead of themselves? We think the combination of the factors just mentioned really support the markets. We do see probably a pullback before too much longer, probably related to the fact that the Federal Reserve will need to increase interest rates at some point, either late this year, but more likely early 2015, a little bit of a headwind for the markets. So as that debate begins, probably in the fourth quarter, we can see that kind of pullback.
Well, we certainly should talk about this again soon as these numbers come in. Thanks a lot, Jim.
Thank you.
Thanks.